On July 4th, 2025, the One Big Beautiful Bill made overtime pay partially tax-deductible for the first time in American history. The headlines celebrated, workers keep more of their paycheck. Social media lit up. Politicians took credit. But buried in the mechanics of the provision is a structural shift that hasn't made the news, and won't, because the people it benefits most aren't the ones working overtime. When you exempt overtime from taxation, you create an incentive, not for workers to work harder. They were already working overtime because they needed the money. The incentive is for employers, because tax-free overtime is cheaper overtime. And cheaper overtime means companies can push existing workers harder instead of hiring new ones. The stated goal is direct relief for hourly workers, but the structural incentives it creates tell a more complex story, one that benefits employers as much as the workers the headlines celebrate. Let's start with the mechanics. Under the One Big Beautiful Bill, overtime pay, hours worked beyond the standard 40-hour work week, is now eligible for a federal tax deduction. The deduction covers the first $12,500 of qualified overtime earnings, or $25,000 if you're married filing jointly. That's not a credit, it's a deduction. The distinction matters. A $25,000 deduction for a married couple doesn't save you $25,000 in taxes. It reduces your taxable income by $25,000. If you're in the 22% bracket, that saves you $5,500. In the 12% bracket, it saves you $3,000. Meaningful, but not the windfall the headlines implied. There are constraints. The deduction applies only to qualified overtime, hours that legally trigger the overtime premium under the Fair Labor Standards Act. Salaried employees exempt from overtime under FLSA don't qualify. Independent contractors don't qualify. Gig workers don't qualify. The provision is structurally limited to hourly workers and non-exempt classifications, roughly 56% of the American workforce. And here's the phase-out. The deduction begins shrinking at $150,000 for individuals, or $300,000 for households filing jointly, and phases out gradually from there, reducing by $100 for every $1,000 over the threshold. This isn't a high earner benefit. It's targeted at the working middle class, and there's a reason it was targeted there. Before this provision, overtime was expensive for employers in two ways: the direct cost, time and a half wages required by FLSA, and the indirect cost, workers resented overtime because after taxes, the take-home premium shrank significantly. A worker earning $30 an hour gets $45 for overtime. But after federal, state, FECA, and Medicare taxes, they might keep $28 of that $45. The after-tax overtime premium was barely worth it for many workers. That reluctance was a natural brake on overwork. Employers who couldn't get voluntary overtime had to hire additional workers. The overtime deduction changes this calculus. Now, the worker keeps more of the $45. Overtime becomes meaningfully more attractive. Voluntary overtime compliance goes up, and the employer gets what they always wanted: more output from existing headcount without the overhead of hiring, training, and providing benefits to new employees. A new full-time hire costs roughly 1.3 to 1.4 times their salary when you include benefits, payroll taxes, and onboarding. Overtime, even at time and a half, often costs less. And now that overtime is tax advantage for the worker, the resistance to it drops. The provision doesn't create jobs, it may actually reduce the need for them. This isn't a conspiracy, it's just incentive design. And in a labor market where companies have spent 2 decades trying to do more with fewer people, a tax-advantaged overtime system is exactly the tool they needed. The overtime deduction didn't arrive alone. The same bill made the first $25,000 in tips tax deductible, with the same phase-out structure. Together, these two provisions tell a coherent story about where American labor policy is headed. Both provisions benefit workers who earn variable, performance-based income rather than fixed salaries. While proponents argue this rewards hard work directly, critics point out that tax-advantaged overtime may lead firms to prioritize extra hours from current staff over creating new full-time positions. Tips are discretionary. They depend on customer behavior. Overtime is conditional. It depends on employer demand. Neither is guaranteed. Neither comes with benefits. By making these income streams tax-advantaged, the system is quietly endorsing a model where a larger share of worker compensation is variable, unstable, and dependent on forces outside the worker's control. The base wage stays low. The variable component, tips, over time, becomes the tax-favored way to earn more. This is what some economists call the performance-gated economy. The tax code isn't just responding to how people work, it's reshaping it. The message to employers: keep base wages modest, offer overtime instead of raises, and let the tax code subsidize the difference. The message to workers: your path to higher take-home pay isn't a raise, it's more hours. The distinction is profound. A raise compounds, overtime doesn't. A raise follows you to your next job. Overtime ends when the shift does. The tax code is making the temporary income stream more attractive than the permanent one. There's a structural exclusion built into this provision that deserves scrutiny. The Fair Labor Standards Act divides the American workforce into two categories: non-exempt workers who are entitled to overtime pay, and exempt workers who are not. If you're salaried and classified as exempt, which includes most white-collar professionals earning above roughly $58,000 per year, you can work 60 hours a week and receive zero overtime pay. You are, by definition, excluded from this deduction. Approximately 54 million American workers are classified as exempt. They are the managers, the analysts, the engineers, the accountants, the nurses on salary, the teachers. Many of them routinely work well beyond 40 hours. They receive no overtime premium and no overtime deduction. The provision rewards hourly workers for extra hours, while salaried workers absorb the same hours for free. This isn't new. The exempt top or non-exempt divide has existed since 1938. But the overtime deduction amplifies the disparity. It creates a tax benefit specifically tied to a labor classification that millions of workers have no access to, regardless of how many hours they actually work. The overtime deduction is real, but it's not universal, and the workers most likely to be overworked, salaried professionals in exempt classifications, get nothing from it. Like many provisions in the OBBB, the overtime deduction is not permanent. It has a built-in expiration, currently set for the end of 2028. This is a deliberate legislative strategy. Sunset provisions allow Congress to pass tax cuts with lower long-term budget scoring. The Congressional Budget Office only counts the cost for the years the provision is active. But the political reality is that once a tax benefit exists, taking it away is nearly impossible. Every sunset provision in modern tax history has been extended, usually in a last-minute deal that adds other concessions. The 2017 TCJA individual tax cuts were set to expire in 2025. They were extended in the OBBB. The pattern is clear. Create the benefit, let people depend on it, then use the expiration threat as leverage for the next legislative deal. If you're planning your finances around the overtime deduction, the prudent assumption is that it will be extended, but not guaranteed. And the extension may come with changes to the cap, the phase-out, or the eligibility rules. Building a household budget on a provision that Congress has to actively choose to renew is building on a political promise, not a structural foundation. If you're an hourly worker earning overtime, here's the practical playbook. First, verify your eligibility. You must be classified as non-exempt under FLSA. If you're salaried and exempt, this deduction doesn't apply to you, regardless of hours worked. Second, track your overtime earnings separately. The deduction cap's at $12,500 for single filers and $25,000 for married filing jointly. If you're earning more than that in overtime, the excess is taxed normally. Know where you stand relative to the cap. Third, check the income phase-out. The deduction begins phasing out at $150,000 for individuals and $300,000 for joint filers. If you're near these thresholds, a Roth IRA contribution or HSA contribution could reduce your AGI below the phase-out cliff, effectively preserving the overtime deduction. A note: these are general observations about how tax planning works, not personalized financial advice. Your situation is unique. Consult a CPA or enrolled agent before making decisions based on phase-out thresholds. Fourth, don't let the deduction change your savings behavior. The extra take-home from tax-free overtime should go to your emergency fund, your retirement account, or your debt, not to lifestyle inflation that assumes the deduction is permanent. Fifth, if you're an employer watching this, and some of you are, understand that this provision makes overtime structurally cheaper than new hires. That's a short-term win and a long-term risk. Burned-out workers quit, and replacing experienced workers costs far more than the overtime you saved. The overtime deduction is a real benefit. For millions of hourly workers, it puts meaningful money back in their pockets. That's not nothing. But zoom out, and the architecture tells a different story. The tax code is now incentivizing variable, conditional income over stable, guaranteed income. It's making overtime more attractive than raises. It's making existing headcount more efficient than new hires. It's building a labor model where the worker bears more risk, working more hours for tax advantage pay, while the employer bears less. This isn't a left or right argument. It's a structural observation. The tax code is a 7,000-page steering wheel. It doesn't just tax your work. It defines what work looks like. And the One Big Beautiful Bill just turned that wheel hard toward a future where the American worker earns more by working longer, not by being paid more. The deduction is real. The question is what it's building.